Today I'm going to start the chapter Public-Private Partnership (PPP). This is basically a contractual. Okay. This is an arrangement between a public agency and a private sector entity to deliver a service or facility for the use of the general public. Public agency can be federal, state, or local. Now there are five types of PPP model. First is service contract, then is management contract, then lease contract, then concessions, then build, operate, and transfer. Build, operate, and transfer include six kinds of model within themselves. So first is service contract. It is when government hires a private company or entity to carry out one or more specified service for a period of typically 3 years, 1 to 3 years, and the authority remains with the primary provider of the infrastructure service and contracts out only portions of its operations to the private partner. Like the whole portion is not given, only some parts are given to the private company to carry out a specific service, and that is all. And the whole authority remains with the government only, and it is maximum for 1 to 3 years. Second is management contract. It is for the daily management is given to a private entity. But the ultimate obligation of the service is with the government only. So all the loss and the profit remains with the public sector only. Third is lease contract. It is when responsibility of a service is transferred from public sector to the private sector, and the financial risk is also borne by the private sector. So the entire operation and maintenance, everything is done by the private sector, and it is like this lease is given for longer period, like for 10 to 20 years, and although the assets are maintained by the maintain like although the assets are typically in reality owned by the public sector, but still no investment is done by the private sector. Okay, so these assets are owned by public sector and no capital investment is done by the private sector. So basically, the asset is leased by the private sector for a time period of 10 to 20 years, and operation and maintenance are entirely borne by them. Next is concession. This is the responsibility for the full delivery of service, including operation, maintenance, collection, management, construction, rehabilitation. Everything is given to the private agency. The capital investment is also done by the private sector, but public sector still owns the asset even during the concession period. So, okay, this is just the like lease contract, but with the capital investment. Okay, next is build, operate, transfer. This contains six kind of model. In this, the private owners owns the asset for a period of time set in the contract to recover the cost at the end of the contract, and then the after that time, the public sector again assumes the ownership. This can be six types: design and build. Next can be design, build, and maintain it. Can be design, build, and operate. Design, build, operate, maintain. Design, own, operate. Design, build, finance, operate, or design, build, finance, maintain, or design. Okay, yeah, that is it. So these were the five kinds of model of PPP. Now next is steps taken by Indian government to promote PPPs. First is viability funding. This scheme supports projects that are economically justified, but they are not financially viable by the government. So they provide a capital subsidy of 20% of the project cost, and the rest of it is borne by the public sector and borne by the private sector. Like some institutions can approve, also grant up to 100 crore for each project, and empowered committee can approve up to 200 crore, but with the approval from the finance minister. Next is the Viability Gap Funding Scheme revamped. So revamped VGF scheme. It is the continuation of the scheme till 2024-25 with a total outlay of 8100 crores, and it was extended to include social infrastructure. Next is India Infrastructure Project Development Fund (IIPDF). This provides financial support to cover the transaction cost. It has the corpus of these 100 crores to quicken the project of preparation. It contributes up to 75% of the project development expenses at an interest free. loan, and 25% is co-funded by the party. Next is PPP Appraisal Committee, PPPAC. The approval of this committee is mandatory for central sector projects of cost more than 100 crore, ports projects of up to 100 crore, and projects having underlying assets of more than 100 crore. Okay. Approval of this committee is mandatory central structure of projects more than 100 crore, ports project of up to 100 crore, or projects having underlying assets of more than 100 crores. Okay. Next is India Infrastructure Finance Company Limited, IIFCL. This was set up in 2006. It is wholly owned by the government and it is long-term finance to the viable infrastructure projects. Model Concession Agreement, MCA. This tells the policy and regulatory framework for implementation of PPP project. MCA Agreement 2021 for ports was introduced. Hybrid annuity model, HAM. This is a mixture of BOT and EPC model, and in this the payment is fixed of like payment is made in a fixed amount for a considerable period and then as a variable amount for the rest of the time, and that variable amount is based on the basis of like asset created and the performance of the developer. Like for example, 40% project cost is paid in the first 5 years through annual payment, and after that 60% is made on the basis of asset creation and performance of the developer. Next is National Monetization Pipeline. This was monetizing 6 lakh crore worth of national government assets from last 4 years. No, yeah, from 2022 to 25. These were like leased and these assets for a long-term basis to private players. That is all. Now, what are the advantages of PPP? This gives access to private sector finance, better infrastructure solutions, increased transparency, faster project transfer of risk. Challenges for PPP is commercial viability, like generating a profit for the projects, insufficient experience in partners, hidden long-term debt for Government of India, long gestation period for the project, negative financial income impact in case of partnership breaks, and transfer of risk from private to public sector. So that is all. Next chapter is global financial crisis. So what happened in the global financial crisis is that first in US people were buying houses using home loans. Now what happened? The prices of houses were going up really fast. Then banks and lenders started giving home loans to people who couldn't even afford them, like who couldn't afford repaying them back without much checking. And so these loans were called subprime mortgages. Now the banks who took these loans like bundled them together into a mortgage-backed securities and sold them to investors all around the world. So what happened? They gave subprime mortgages, then bundled them together into mortgage-backed securities and sold them to investors all around the world. Then these investors sold the MBS box to like the to people who were looking to make money out of the stores. Now the MBS box were bought by people who expected to receive money over time. Now this money came from the people who were giving monthly payments for the people who borrowed the money to buy their houses. Now these borrowers paid back their loans with interest as well, and investors were making profit. Now what happened? Suddenly the housing market started to decline, and this caused a problem in the for the banks and the lenders because they had given loans to people who couldn't actually repay them, and since the loans were tied to the value of the houses, when the prices started to fall down, people what they did is they stopped paying back their loan and they just like gave up on their house and they started defaulting on the housing loans. So investors became less willing to purchase the MBS and like yeah, and actively sought to sell their existing MBS holdings. Now what happened? MBS prices also declined, and the whole net worth of the MBS investors started to like decline rapidly. Now a turning point came when Lehman Brothers. It was a 168-year-old investment bank with 639 billion assets. They filed for bankruptcy, and overall, then the 2007 financial crisis ushered into the 2008 Great Recession. High level of household debt, a housing market slump, and declining global trade resulted in a widespread economic downturn. That is all. Now, how did it impact India? It impacted India in the stock market, decrease in exports in export-oriented sector, currency depreciation, growth rate. The GDP moved down to 5.8% during the second half of 2008-9 from 7.8% in the first half. Now, what were the positive impact of India? The fall of international commodity prices, more particularly on the crude oil, reduced the import bills for India. What were the steps taken by RBI? They, from mid-October or in 2008, they started acting aggressively to ease the situation. They started a series of rate cutting and liquidity injecting measures till April 2009. This RBI brought down the cash reserve ratio from 9% to 5%, the SLR from 25% to 24%, and the repo rate from 9% to 4.75%, and reverse repo rate from 6% to 3.25%. Now, also some special steps were taken, like the RBI opened a special window for banks to lend to mutual funds, non-banking financial companies, and housing financial companies. Now, they also opened refinance facilities for banks, especially for SIDBI, National Housing Bank, and the Exim Bank. These were the steps taken by RBI. Now, what were the steps taken by Government of India? Now, they now see three successful fiscal stimulus packages. One in early December, next in early 2008, second in early 2009, and the last one in March 2009. The fiscal burden for these packages amounted to 1.8% of GDP. It includes reduction in central excise duty by 4% points, addition plan spending rupees 200 billion, additional borrowing in state government of rupees 300 billion for plan expenditure, and assistance to central export industries in the form of interest subsidy on export finance. The additional plan spending of 200 billion, additional borrowing by the state government of rupees 300 billion for plan expenditure, and assistance to central export industries in the form of interest subsidy on export finance. Okay, that is all.